Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today we welcome back our good friends from Moss Adams Automotive and Dealer Services Group, Senior Managers Sarah McKnight and Brittany Richards. We'll also have two dealers joining us, our Chairman Jason Quarter and from Los Angeles, Howard Hake. They'll be asking Sarah and Brittany some questions toward the end of the program that fellow dealers will find beneficial. Girls, I know you have a lot to cover and I don't want to take up any more of your time, so the floor is yours.
Thank you, Rachel, for the introduction, and thank you, AIADA, for having us back today. As you all know, this program has been full of confusion and uncertainty, and although there has been additional guidance since we last met, that has cleared a few things up, there's still a lot of unanswered questions out there. Today, our goal is to give you a high-level update on new guidance that we feel is most relevant to the industry, and then spend as much as time possible answering your questions based on the information we have today. So let's get started. In this section, we're going to do just that, update you on the most recent updates. Because we're going to hit the highlights, I wanted to give you all the links to some of the most recent guidance that we have so that you can go and do some reading on your own if you'd like to get some more details or also talk about some of the points that we aren't going to talk about today. So with that, I'm going to hand it over to Brittany to take us through the highlights of the Paycheck Protection Program Flexibility Act. That was a mouthful.
Awesome,
Brittany?
Thanks, Sarah. So the PPP Flexibility Act was signed by the President on June 5th. So it's been around for a couple months, and I'm assuming that a majority of you are most likely familiar with the key points from the Act. But just in case, here's a quick recap of some of the important provisions. Probably the biggest and the most popular item was the update to the covered period options. The Flexibility Act allows for an extension of the covered period from the initial 8 weeks up to 24 weeks. So for loans funded after June 5th, the default covered period is going to be automatically the 24 weeks. However, borrowers who received their loan funds prior to June 5th will still have the option to elect an 8-week covered period. One of the big questions arising from the change to the covered period is whether or not you can apply early or prior to the end of that official 24-week covered period. And the short answer is yes, but we will expand on that a little later this morning. The Act also reduced the amount of qualifying payroll expenses required from 75% to 65% of the loan forgiveness amount. Additional provisions included relief to borrowers in the form of postponing the wage reduction and the FTE restoration date from the original cutoff of June 30th to December 31st now, and also provided multiple safe harbors for employers experiencing circumstances that are outside of their control, so such as employees who voluntarily chosen not to return to work or who've experienced, those employers who've experienced business activity limitations for reasons that are related to compliance with the local, state, and national health mandates in place at the time. The forgiveness application submission deadline was also revised to provide a window of 10 months from the end of your covered period to apply for loan forgiveness, and additional changes included an expanded loan term to 5 years and also additional deferral of the loan payment. However, for loans funded prior to June 5th, keep in mind the payback period is still 2 years, but it can be extended if mutually agreed between the borrower and the lender. The Flexibility Act provided some good news related to deferral of employer payroll taxes, which is through the end of 2020. And then one additional item to note, the Flexibility Act did announce audits of all loans over $2 million. And do keep in mind that this includes related party loans, which total $2 million or more. So you'll want to carefully consider all related party PPP loans when ultimately determining if you're subject to the $2 million loan automatic audit process. So in addition to the Flexibility Act, the SBA also released updated FAQs for the forgiveness application process. We wanted to go ahead and highlight a couple of those. So Sarah, can you kick us off with a discussion on the interest?
Sure. So like Brittany said, they have issued some updated FAQs on forgiveness. That link was on the previous slide. So if you want to go read that complete list, that link is there. And there's some good information there. One of the items that has kind of been a question from the beginning is if we're able to include floor plan interest as a forgivable interest cost. And there were a couple questions on the FAQs that finally have given us a little bit more guidance. This first question was, what is the definition of business mortgage on personal property? And this FAQ lays out that a business mortgage is one where the property secures the debt, which is the case for most dealers' floor plans, whether it's a line of credit or a traditional floor plan line. The vehicles are securing that debt, and it specifically goes on to say that unsecured credit, although you can use the PPP funds to pay that interest, it is not included in forgiveness. And then the other question that a lot of us had was, the rule that the lease or the mortgage had to be in place by February 15th. And the question was, any vehicles that came in after February 15th, could we include the interest on this? And then this question goes into talking about renewed leases and refinanced mortgages and things like that, and just saying as long as the existing note existed prior to February, and if it's refinanced, it still counts. So again, good news for floor plan interest.
Many of you have been anxiously awaiting information on the taxability of expenses that are related to any amount of loan that is forgiven. The skeptics among us are wondering, is this money really tax-free? And our pessimist friends do have good reason to be skeptical on this point. Congress has expressed that the original intention is the loan forgiveness should not negatively impact a borrower's tax liability. However, under normal IRS guidance, and for non-taxable income, the related expenses associated with any tax-free income items are in turn not tax deductible. While this doesn't align really with Congress's expressed intention, at this point, unfortunately, there hasn't been anything that has addressed or any law introduced yet to rectify this. And this does lead to a number of additional questions related to tax reporting. First of all, the loan forgiveness amount is likely not going to be determined until 2021. At this point, with very few lenders accepting applications and very little known about the processing of these loan applications and the ultimate forgiveness timeline, it's highly likely that that ultimate forgiveness amount won't truly be known until next year. So what do we do about 2020 tax returns and the potentially non-deductible related expenses? Until further guidance is provided, we've been working under the assumption that these will indeed be non-deductible, and that until Congress proposes a law change, we'll approach it that way. So there's really a limited amount known at this point as to whether, if 2020 tax returns are reported and ultimately we find after the fact that there is a potential to have some of those expenses as non-deductible, we may need to amend the return. But I think at this point, the best approach, if you can, is to wait and file your 2020 tax returns if possible until we have additional guidance, to avoid the hassle of having to amend if it comes down to it.
And Brittany, I did want to point out that there is a draft bill out there that addresses this. However, it has not moved in quite some time. Also, there were some of the initial drafts of the Flexibility Act had a correction of this, but the final one did not. So I just found that interesting that they have really not seemed to be able to come to an agreement on that issue, even though it doesn't seem to be what the initial intent was of the loan program.
Right. So hopefully they will address that at some point sooner rather than later. But I think from a conservative standpoint, we've been under the assumption that they will be, non-deductible tax items. So another important update. So the SBA has also released updated interim rules related to the treatment of owners and the forgiveness of certain non-payroll costs. So for employee owners, if their ownership is less than 5% in a C corporation or an S corporation, then the individual is not subject to the owner-employee compensation rules. Otherwise, employee compensation for greater than 5% owners is limited to either 2.5 months of the 2019 compensation, or subsequently capped at either $15,385 for an 8-week period or $20,833 for a 24-week period. One item that we found interesting to note is that there's been no mention in this or indication of any related party ownership structures and whether or not related party owners who cumulatively own more than 5% are also subject to the rules. So hopefully we will be receiving more guidance on that topic in the near future as well. And with that, I think Sarah is going to talk to us a little bit about the development with related party rents over the last couple days.
So this slide has some asterisks because it's a pretty important update. It's something that, although disappointing, is not necessarily surprising to us. The idea of related party rent has been a question from the beginning, and the ability to include those rent payments as qualified rent expense during the covered period. Well, along with the interim rule about owner in S corps and C corps, we've got this updated related party rent rule, and basically what it says is that if you have payments to a related party for rent, the only amount that is includable is the interest on the mortgage that's associated with that property. So basically the idea of this is trying to level the playing field between a dealer that owns their rental entity or their rental property outside of the dealership entity, and those who own it and have a mortgage inside the dealership entity. Basically saying the only thing that you can deduct is the interest related to the mortgage. This is pretty disappointing for a lot. This is going to change your calculation probably fairly significantly, especially if your related entity has paid off the mortgage. It takes your rent factor from the full rent down to basically zero. So if you were planning on using the 8 weeks, this is going to significantly reduce that rent factor and probably change and maybe make you want to think differently about maybe waiting the 24 weeks. The other piece of this is, typically in tax law, we see related party conversations about, common ownership of 50% or 50% or more. This rule says that any common ownership between the business entity and the property owner is considered related party. So again, really not great news for us. The interim rule also included additional guidance on the deductibility of rent or the inclusion of rent if you have a sublease. So if you have a situation like that, you may want to go read those instructions a little bit closer.
All right, and with the recently released guidance, there has still been left with some burning unanswered questions. One of those questions is, how do I actually qualify to utilize Form EZ, and or what documentation do we utilize for the safe harbors? Just for a little bit of background on the EZ application, the SBA has released an abbreviated or a short form that allows borrowers to provide more limited information if certain circumstances or conditions are met. While we're not necessarily suggesting that the EZ form should be utilized, it is important to understand the conditions required to elect to submit the EZ form rather than to use the full form. So what are some of those conditions? We're going to highlight two below. So the first one is that the borrower did not reduce wages by more than 25% during the covered period. And the second is that the borrower was unable to operate during the covered period at the same level of business due to compliance with COVID regulations. So how exactly do we calculate and prove out that we meet these safe harbor tests? Do we just utilize the form in good faith and provide information if requested under audit? Sarah's going to dive a little bit into requirement number 1 so we can understand this portion a little bit better.
So probably one of the biggest questions for dealers are, do commissions count in the reduction calculations? And we've been kicking around this question for some time, and the FAQs give us a little bit more guidance on it. And this first one asks if only salaries and wages are included in loan forgiveness, or if lost commissions and bonuses can also be included. And the answer goes on to state that all forms of compensation, including commission, should be included in qualifying expenses. So this is great news. So when calculating your payroll costs, they're basically saying you include all forms of compensation, but it specifically lists commissions as separate from salaries and wages. And then the second one asks if all forms of compensation should be included in the 25% reduction calculation. And the answer says just decreases in salaries and wages. So although for the purpose of these two questions does not appear to be to define commissions, it is helpful. And I think for now we can reference it as an indication that the intent is for them to be separate, and that when you're doing that 25% calculation, you just have to include base salary or base wages. So if you didn't change anybody's pay plan, I think for now we can reference this and say that we did not reduce it below 25%. Of course, we may see further guidance like we just did on the related party rent, but for now, we kind of can rely on these couple questions.
So what if you're a borrower who believes they qualify for the safe harbor under item number 2? Then the question arises, well, what type of documentation do we need to remit or retain in order to support the inability to operate at normal levels? There's currently very limited guidance as far as what type of documentation is going to be provided or requested. The SBA has given lenders a good amount of freedom to tailor the PPP forgiveness application process. So the requested documentation may ultimately depend on your lender's specific requests. Until further guidance is received, I believe a good faith effort should be made to comply with the eligibility requirements in order to utilize the EZ form. And until we receive further guidance, if a borrower does believe in good faith that they're eligible to check the box and self-certify compliance on the safe harbor provisions, then it would be okay to utilize the EZ form. However, the borrower should be prepared to provide backup documentation supporting that limited business activity. And as previously mentioned, that documentation is going to vary widely depending on your circumstances. So it will be important to work with your lender and your tax advisor to really determine what's sufficient for your circumstances. And so at this point, Sarah, I'm going to pass it back to you and we can jump into the next section about pros and cons on applying for forgiveness.
Great. Yeah, so we get a lot of questions from clients on, should I apply after the 8 weeks versus should I wait the full 24 weeks? So we just thought it would be good to take a few minutes to talk about some of the advantages and potential disadvantages of using the 8-week period. The first one is just, kind of the basic math of forgiveness. This slide is a high-level hypothetical comparison of the two different covered period options. In both scenarios, your loan amount is the same and your base FTEs for comparison during the covered period is 70. In the 8-week period, we assume no reduction for wages below the 75% and that you maintained your previous headcount. In this scenario, your total qualifying expenses did not add up to reach 100% forgiveness. So in this case, your qualifying wages and other expenses weren't quite high enough to reach the full forgiveness potential. So then in the 24-week period, we project out some more qualifying wages. However, we show, that maybe during the full 24 weeks, we had to have some headcount reductions down to 55, and then also some people's salaries and wages had to get cut. But because of the longer period, our just total qualifying expenses are so significantly higher that we end up with a full forgiveness of the loan. So it's just one of those things to think about, is that maybe more time is just better to guarantee and potentially guarantee that full forgiveness. Of course, this is a demonstration and you should run your own numbers and then also continue to look for guidance from the SBA to see if any of these assumptions change.
So there are a few potential pros and cons to consider when thinking about whether you should apply using the 8 weeks if applicable, or applying earlier than the 24 weeks. So, we understand this hasn't been an easy year for anyone, and with constantly evolving guidelines, it's been very stressful and painstaking process for many of you. So we understand you're ready to get closure and to move on. So depending on your specific situation, let's say you've maintained employment levels and compensation levels and you believe you qualify for 100% forgiveness at this point. Some of the potential benefits of applying early could include a reduction of debt on your financial statements, as well as the recognition of the forgiveness income on your financials. Additionally, the fact that little is known about the SBA availability for audit and approval timing, being first in the door could potentially boost your chances of pushing your application through early with less scrutiny, but that's definitely a shot in the dark on that one. There are also some potential downsides to applying for forgiveness using an 8-week covered period. The biggest in my mind is just the continued uncertainty and evolving guidance on the program in general. Additional time may very well mean additional and or full loan forgiveness by either taking advantage of safe harbors available through the end of the year for those FTE and wage reductions, or by just being able to incur enough eligible cost to receive full forgiveness regardless of reduction tests. So that's one thing to keep in mind. On the flip side, while SBA availability for audit and approval could potentially be a good thing, it could also potentially be a detriment if you apply too early. Depending on how the process goes, it could actually flag your application for additional scrutiny. So that's one that could go either way for you, but is something to consider. A final factor to consider is the tax implication and the timing for the recognition of the non-deductible expenses. So for example, if a borrower utilizes an 8-week period, then the income associated and those additional expenses would fall into the 2020 tax year. However, if you're utilizing 24 weeks or a longer covered period, that event may not occur until 2020. So really, this is going to require you to look at the situation that you're in with your tax advisor and see what makes the most sense for you. And so now that we have kind of talked through a little bit of those pros and cons of when to apply or how to apply, let's talk about when we can actually get our application in the door. So there are a few additional things to consider. One being, is your lender accepting applications? At this point, I believe only one lender in our group of clients that we know of has officially opened the application process. Many lenders have scheduled to open their application portals, but then they subsequently push the date back due to the changing regulations and the continued uncertainty. Additionally, as we mentioned earlier in the presentation, the expansion of the 24-week cover period, has many of us asking whether we can apply earlier than the 24-week period. The most recent FAQs released do address this and appear to confirm the ability to apply prior to the end of that 24-week period. However, it is important to note that if you choose to apply early, it's our understanding that the borrower must project the wage reduction out for the full 24-week period. So that could potentially affect the full forgiveness amount from the standpoint of a wage reduction. Conversely, the FTE reduction calculation is a little bit more ambiguous. It does reference a potential cutoff date in the application, but that is uncertain at this point. So what we have been advising at this point is if you want to be pretty darn sure that your head count is going to be significantly the same as it is or is expected to be at 12/31 if you are going to apply early. So Sarah, do you want to talk a little bit about how borrowers can minimize the impact of this whole PPP application process?
So yeah, let's take a minute to talk about, how overwhelming this has been for everyone and how much it has consumed so many of our lives. We know we have a lot of our clients have been spending the last few months, just consumed by the Paycheck Protection Program. Trying to understand the lack of guidance, running projection calculations, things like that. And so, with the update to the 24 weeks, and then obviously we're continuing to get more guidance just this week with the related party rent, it may be appropriate to just take a wait and see approach. Knowing that you'll have quite a few expenses through the 24 weeks, and even if you have a headcount reduction because we don't know what the future holds, it still may make sense for you to just wait the 24 weeks and see what else we know. And then, of course, you're going to want to continue to monitor guidance and just see if there's any more indication of kind of, when the appropriate time is to apply for forgiveness.
Excellent. So a couple other ways to minimize the impact is to keep in close contact with your tax advisor. You know, as public accountants, especially in the dealership realm, we are dealing with these questions on a near daily basis. So utilizing our knowledge and experience will be very helpful for your circumstances. This program is new to everyone, and each situation is unique. So we're constantly fielding questions from our clients in a wide range of scenarios. So we do have the benefit of just a wider industry coverage and pulse on what those developing best practices are. Additionally, as Sarah mentioned, guidance is constantly changing. So it's important not to focus too much time and energy on the actual application and the tables until you're really ready to apply. It's important to know what the requirements are and have a plan, but really wait on executing on the legwork until A, we know more, and or B, you're actually ready to apply. And we do have the benefit of time in most cases, so it's important to utilize that. Also consider ways that we can minimize the required documentation. So for example, we do have some clients that have mentioned they are only going to be including qualifying payroll costs on their forgiveness application. This is going to allow them to eliminate some of the additional documentation and support for those non-payroll costs, and will allow the borrower to really focus on the payroll reporting and schedule. So that's one thing to keep in mind if you do have an abundance of payroll costs, to maybe limit what you're actually asking forgiveness for if you're already at the maximum amount.
So I think that's the end of our prepared presentation. Next, we have Jason Corder and Howard Hakes, who are going to ask some questions that some of you submitted ahead of time. So.
Well, thank you, Sarah and Brittany, and of course, Moss Adams. Always informative when we hear you guys. You know, you answered all 4 of our questions that we already had prepared. So really, I'm going to ask a couple clarifying situations or questions that I had. One of them was the inability to operate at the same level, and talking specifically about documentation. And I know that was the answer to that is maybe a wait and see from our lender, what they might request. Is there anything that you would suggest to your clients right now as specific examples to kind of prepare for of what some of those examples of documentation would be?
Sure, I would say that there's quite a few things you could document. I think a few of them would be, you know, your local and state stay-at-home orders, or, you know, guidance from your local government on how you should operate your business. I know here in Washington we had some shutdowns that were required, so, you know, definitely that operating, how you're changing how you're running your business. You know, did you have to have less techs in the shop because you couldn't maintain 6 feet of social distance at a certain time? You know, any of those kind of things that you've been changing that kind of changes how you've been able to have your employees work are great things to document.
Thank you.
Another question came in. I mean, for the purpose of FTE comparison, should commission employees be counted as salaried or hourly?
So we don't have, none of the guidance we have so far has actually given us exact guidance on that issue. However, I would tend to lean towards how you typically treat those individuals. For example, if on your local payroll tax reporting, you treat them as full-time employees because you're not counting their hours. If they typically clock in and clock out and you have those numbers, then I would treat them as their typical clock in, clock out. However, if you don't keep track of those hours, then I would lean towards treating them as full-time equivalents. Brittany, do you have any other thoughts on that?
No, that's what we've been advising the clients that I'm working with on as well. So yeah, if there's a way that we can, you know, reasonably track that and have tracked that, then we'll utilize that. But in other cases, we treat them as a salaried employee.
So one of the other questions that I'm looking for on clarifications is when we talk about what some of the IRS guidelines are and the changes that could be coming, but the intent was this to be tax-free. Is a loan really tax-free income on the amount that is forgiven? What's your prediction?
Oh, if I had a crystal ball, I mean, like we've mentioned, from just normal tax perspective, if you do have non-taxable income, which they have, clarified the CARES Act is considered non-taxable income, then any corresponding expenses are going to be disallowed for tax purposes. So in essence, it does become a taxable event. Um, I'm hoping, I mean, all indications, and like Sarah had mentioned earlier, there has been a draft of potential law that changes that piece, and so, but it's kind of sitting there at this point and hasn't moved. So honestly, at this point, am under the impression that they likely will not address that. But Sarah, maybe I'm being pessimistic. I don't know, Sarah, do you have a different opinion? I'm just like, oh, I don't know if they're going to do it.
Yeah, no, Brittany, I agree because I think we were all pretty shocked in the first place that it was tax free. And then when the IRS came out with their guidance, yes, that made sense to more of us tax people, although disappointing. And then again, the fact that the correction was in the draft Flexibility Act, but didn't stay leads me to believe that they're, for some reason, they can't seem to agree on that. So I guess we're being pessimistic.
Oh, yeah.
So can I ask a B part then? Any concerns about applying for forgiveness if a company has been profitable these months since COVID?
When we applied for the loans, there was a lot of uncertainty. And back to documentation, I think it's really important that we document the uncertainty that we felt when we applied for the loans. And then also, I think everybody would agree that we don't have a crystal ball and that there's still uncertainty going forward. I know everybody's struggling with inventory issues. We don't know what the fall holds as far as the pandemic goes. So again, I would just be documenting that in your company's minutes and how the uncertainty that you're currently feeling. So
Another question came in regarding, you have probably half of the dealers with big employee counts have loans of over $2 million. And what would be a recommendation of making sure you have extra documentation or things available for an audit when the audit does come? And do you have any idea what an audit might look like from the SBA?
Right. Brittany and I were talking about this earlier. Part of our presentation was talking about, utilizing the EZ form. And the issue with the EZ form is it's easier to fill out, but you still have to have the documentation to support it. And if you have to do the work to have the documentation, does it make sense to just submit it ahead of time? The question is if I submit the EZ form, are they then more likely to come audit me and want to see the documentation anyways? So I think, especially for the $2 million, making sure all your documentation is in order based on the application guidelines. And, the SBA historically has been pretty tough audits on the things that they've audited. So again, just, more documentation, the better. And I think more transparency in your calculations, the better.
Terrific. Thank you. I think the only other question was on safe harbor of maybe a little conversation I saw in there, safe harbor 1 and 2. Can you guys kind of explain a little bit about the safe harbors for people that haven't started to look at the forgiveness package yet when they get there? Because that was kind of a confusing piece.
I'm sorry. So, which safe harbors in particular, or?
Well, I think wasn't there, and I don't have it here. Wasn't there 2 safe harbors, safe harbor 1 or 2?
Oh yes.
Just a quick coverage of just when people get there, kind of what they mean and who would qualify for those. What would qualify for those?
Sure. So the first, requirement that we talked about is that the borrower did not reduce wages by more than 20% during the cover period. And so, under the safe harbor rule, we actually have, until 12/31 to reduce those or to restore any reduction in wages. A lot of times this is just going to be a calculation that you're going to have to dig into employee by employee, which, is one of the things that makes this process so complicated. So it's really just going to depend on how that pans out by employee as you're modeling things out on whether you actually comply with that safe harbor. I think that the second safe harbor for the inability to operate at the same level because of COVID is a little bit easier, just because there's less guidance, but I think it's also easier to be able to document whatever your local maybe social distance ordering was, emergency mandates. So I think that piece of it is a little more straightforward, in my opinion. If you have, a local order to maintain 6 feet distance, that right there is going to hinder your ability to operate at the same level of business in a lot of cases. So I think that one will apply to a large majority of people, in my opinion. Sarah may have a different thought on that.
And I agree with that. And the frustrating with the thing about the safe harbors is I think they've been one of the biggest confusions in all this. And I would just go back to what I said before, is that in order to figure out if you qualify for some of those safe harbors, you have to do the work anyways. You have to do the calculations, you have to do the documentation. So if after you do that and you're using, say, the 24 weeks, you still qualify for 100% forgiveness, does it make sense just to provide the information as opposed to hang your hat on those safe harbors? I was just going to address one other question that I thought was really great that I saw in the chat, and the question is, if we elect forgiveness between 8 and 24 weeks, is the compensation limit of $100,000 annual the $15,000 or the $46,000 or somewhere in between? And I don't actually know the answer to that question, but I would lean towards somewhere in between. I would probably do that calculation based on the number of weeks of payroll that you're planning on using. So
yeah, that would be my opinion as well. And it does look like we have a couple questions that came in via the chat function. One of the questions is regarding floor plan interest. Is the interest eligibility limited to loans originating after a specific date? So I think based on my reading and recollection, it's really loans that are made before a certain date it's the key. So any loans before February 15th that are in place would then be eligible as a payroll cost. Is that your understanding too, Sarah?
Right. I think as long as your floor plan line is in place before February 15th, but the specific cars in and out, I don't think is relevant. I think as long as your line is in place before February 15th, you can include the interest. So
yes, exactly. That's a good clarifying point there. And then, another question is, how will the forgiveness work across 2020 and 2021? So, expenses incurred in 20 but forgiven in 2021. That is a great question. Unfortunately, it's one that we don't have a great answer for. At this point, from normal tax, planning perspective, if it is a 2020 expense, then it would need to be reported in 2020. But we might not know about it until 2021. So will amended returns be required? We're not really sure. I don't know if you have any additional inclinations on that, Sarah, but I think it's a big unknown at this point in my mind.
Yeah, I agree. And I think with that, we'll hand it back to you, Rachel.
Sarah and Brittany and Jason and Howard, thank you guys for speaking with us today. This is really important information that we felt that we had to get out as soon as possible. So just thank you again for rising to the challenge. We always appreciate you coming back to help us navigate these uncharted territories. To those on the line, you'll be receiving a recording of this webinar by early next week. I've also seen all of your questions come in, and those that were not answered, I am going to pass along your contact information and your questions to Sarah and Brittany, and they will get back to you. There's a ton here, so probably next week at some point, so please be patient with them. They're very busy. If you'd like slides from today's presentation in the meantime, you can email me at S as in Sam, OLI, MANIR, Soleimani R, at AIADA.org. For more information about AIADA, visit AIADA.org. Thanks for joining us and have a great day, everyone.